Welcome everyone. Today we're gonna discuss internal control and CAS. Okay, we are using a fundamental accounting principle issued by McGraw-Hill. So there are a number of objectives from 1 to 7. We'll go step by step. Okay, in these lectures, from explaining the principle of internal control, explaining the CAS. Applying the internal control to CAS, explain the record and petty cash transactions, explain identify the banking activities, and prepare bank reconciliations, and calculate a number of ratio to determine the company liquidity. There is a number of video, Canary Bigas Homegrown Tax Security Story, the intensive candidate that you can go over here and look at itself. There's a YouTube video link here that you can use, okay? Alright, we can go to the first one, the critical challenge, okay? A debit card is issued instead of currency to purchase a $10 item. Would the journal entry to the buyer be affected? Okay, you need to analyze this, okay? A debit card, so means it's cash purchase, okay? There's a cash purchase, means that there's an item, let's say let's say a toothbrush is $10, you register that, and then cash is going to be out $10, okay? That's an example of journal system it will affect, right? Remember that. Let's try the internal control system objective number 1. All policy procedures is used to, number 1, what is it used for? To protect assets, for ensure reliable accounting, promote efficiency and operations, encourage adherence to company policy, adhere to sustainability targets set by the management, and collect the accurate data relating to the sustainability target, okay? There is an important thing in terms of this one, okay? Remember the CARS principle, attribute to the strong control system that can be broken into easily. Remember the acronym CAR, custody, authorizations, and recording asset. This must be always performed by each separate individual to make sure and to reduce potential error and reduce opportunity to fraud to take place, okay? A weakness of control can be identified by two of these tasks that are performed by the same individual. So, remember I mentioned to you in the previous video that cash has to be managed by different persons to ensure the effectiveness of the control. Okay, principle of the internal control. Establish a separation of duty, ensure transaction and activities are authorized, maintain records, ensure asset and bond to key employees, apply technology control, number 5, and number 6, to perform internal and external audit, okay? Solving problems. So, to provide full analysis of control issue, it's helpful to remember the acronym of WIR. First, you need to identify the weaknesses due to the card issue, and then explain how the weak control will cause an error, okay? There are 3 drivers of fraud here. Opportunity, motivations, and rationale. There's a fraud of triangle, okay? Make sure there's a 3 drivers of fraud that's identified, okay? In PricewaterhouseCoopers 2020 Global Economic Crime and Fraud Survey indicate that there's 4 types: customer fraud, cybercrime, and asset misappropriations. Number 4, bribery and corruption. According to the survey, fraud mostly committed by customer, accounting fraud, antitrust, human resource fraud, bribery, and corruption are increasing over the previous year. 3 drivers of fraud. Look at this. Consumer market, 18%. Energy, utilities, 17%. Customer fraud is 27%. All of this, right? Health industry, 16%. The highest one, industrial one. The second highest, 21%. The number 1 in terms of customer service, 27%. See? Look at the level of fraud here. 3 drivers of fraud. Properties of the fraud, either external, 39%, which is mostly done by customers or hackers or vendors. Internal properties, 37%, done by middle management, 34%. Collision with the internal and external, 20%. So, frauds committed by those invited by internal perpetrators by vendor or supplier represent nearly half of all the frauds reported. Okay, because collisions. Okay, kickback, bribery, all of this is commission based. This is a common fraud that has happened. Fraud prevention method: reduce the processing error, more excessive testing, limited evidence of processing, increase the level of e-commerce. Okay, there are several ethical impact. Okay, warning sign here. There's such as customer refunds increase, and then missing documents, and then difference between bank deposits and receipts. So this has to be a lot of reconciliation activities been done by finance department. Increase customer supplies complaint. The warning sign also can see the employee sign, include lifestyle changes, failure to leave the job, and not even do a vacation. Okay, so in some countries you are required to do a 2 weeks vacations. Okay, because to ensure that everything is going smoothly and there's no fraud involved. Okay, one of those things. Limitation of internal control. There's human error such as negligence, fatigue, and misjudgment and confusions. There's also human fraud, intent to defeat, internal control for personal gain. This is the most common one. Cost versus benefit. The cost of internal control must not exceed their benefits. Okay, that's the one. And then your checkpoint here, the fundamental principle. What are the impacts in technology? So most of the time now is getting automation through the e-commerce system. So that's the idea, to reduce the level of fraud through e-budgeting. That's a good example. Cash. Cash is the most important asset. This is objective number 2. Cash is the most important asset that you need to manage. One of the most important assets because it's liquid and mostly the most common being misappropriated. Due to the high risk of theft, company implement a very effective control of cash handling, check processing, and electronic payment. Good accounting systems support both in managing how much cash in hand and controlling access to it. Okay, so when I was in Royal Airlines, I was handling the petty cash. So every day, it's always being checked how much is left in terms of the money in the petty cash and how much in the book. Make sure it is all the same. Okay, let's say in the petty cash in the box there you say $1,000 and the book must also say $1,000. Okay. Excuse me. Cash define. What is cash define? Financial statement line item cash includes such as currency, coins, amounts, deposit in a bank account, checking accounts, and most saving account. Okay, so most companies have a financial analyst to reconcile all of these items. Okay, treasury, usually the function of treasury. Cash also can include deposit in a customer check, cashier check, certified checks, e-currency, and EFT, electronic fund transfer. Okay, many companies invest either cash in short-term investment called as cash equivalent to increase the earning. So, okay. Example, yeah. Amazon.com report following in December, cash and cash equivalent $41 billion. Okay, that's a good example. Liquidity. Cash is a usual means of payment when paying other assets. It refers to how easily asset can be converted into another asset and used in paying a service or obligation. Cash and cash equivalent are called liquid asset because they are converted easily into other asset and used in paying for the service and liability. Most companies have maintained a certain level of liquidity to make sure they are able to pay bills on time and make purchases when it is necessary. Okay. Objective number 3, you must be able to control the cash. It is the principle of good internal control to cash. Cash is the most liquid and easily hidden. Okay. A good system of internal control must have procedures for protecting both cash receipt and cash disbursement. There always has to be check balances. Because cash is the most liquid, specific control need to be placed in handling those cash. Okay? Control cash class. This is a typical separate strategy of basic lines, such as number 1, separate handling of cash from recording cash. So, check and balances, different person. They deposit cash receipt promptly in the bank. So when we were working for Campbell Soup in Godiva Chocolatier, every day, at the end of the shift, the store closing, all the cash has to be deposited to the bank right away, the same day. Okay, cannot be delayed. It has to be deposited the same day, so it can be reconciled by the head office. Make cash disbursement by check. All the cash disbursement that's over, let's say $1,000 or $500, must be done by check. So people cannot make swindle it. Okay. All right. Let's personal finance series. This is another textbook that I will pass this slide. Control of cash receipt. Intercost receipt ensure that all cash receipts are accurately recorded and deposited. That is correct. When I was in the finance department in Royal Sun Lines, all the cash receipt that we receive in terms of sales, customer account, interest and rent, bank asset, and owner's event, we receive it every day and record it. The two important tax cash receipt will be over the counter and mail. Okay. Control of cash receipt. Over the counter, its purpose could be control cash register at the time of each sale of intercontrol. Many software programs facilitate point of sale, register transaction, and enter them in the accounting record. The last dependent register simply print a record of each transaction on paper tape or electronic log in the inside register. Cash register here, cashier will be here, computer here. So it's a different way of doing things. Okay, it's all allocated in different ways. It must be reconciled by the financial analyst. Okay, usually treasury analyst. Okay. Control of cash receipt, there is cash and over and short. Sometimes there's an error, and the differences must be reported as a cash over and short account. For example, when I was a manager at a Godiva chocolate store, so my sales clerk or my cashier always register. We always reconcile the day. If there's a cash over or cash short, we always write down how many short, how many over. Okay, that's the most important things that we have to do in terms of controlling the cash. Income statement account include the general analysis expense, and when errors, making changes, making petty cash receipt. Okay, control cash receipt by mail. Arrive through mail. Start with the person who opens the mail. Okay, that's a control. Control cash disbursement. Control cash disbursement is especially important for companies. Most last theft occur from payment at fictitious invoices. This is the most common time theft. Okay, the three-way matching is good control of cash disbursement. So there's must be a control of three-way control system. So there's the exact procedure used to achieve control over cash varies depending on the companies in terms of sizes, in terms of employees, in terms of transaction, and source of cash. There's three control systems. The people that when the petty cash officer, the reconciliation officer, and another one is the managers who will control all this cash disbursement. These are the checkpoint. Good internal control. Procedure cash receipt imply that those all cash and other than those very small amount are made by check. An accounting firm must count receipt from sales and cash receipt by mail. Okay, these are the example that you will be tested in your practice. Now, objective number 4. Petty cash system of control. A basic principle of controlling cash disbursement is that all payments are made by check. This is the most basic. If any disbursement, all payment must be done by check. Exception to the rule is that petty cash disbursement is only a small amount required. The most common, such as postage, current fees, and repair and supply. This is the most common one. Let's say that less than $100 or less than $200. Let's say you have to do it in a petty cash. The purpose of setting a petty cash fund is to prevent companies from having write check in a small amount. Okay. Once the business set up for petty cash, it must be maintained and fund can be used to make small amount. Example: when I was with Royal Sun Alliance, the petty cash amount is $1,000. Any disbursement less than $100 or $200, it can be used by petty cash. Okay. Operating petty cash fund, establishing a petty cash fund requires estimation of the total amount likely to be made during a short period, such as week or months. Check is then withdrawn by company cashier for an amount slightly in excess of this estimate. Example of operating cash fund here. Example, okay? Trendy machine bag company, Limono, okay? Established petty cash fund November 2023, amount of 75, okay? So how you book it? Petty cash 75, cash credit 75. This is how you're gonna book it in terms of record keeping, okay? Operating cash fund. The entry transfer 75 from regular cash to the petty cash account. The petty cash fund is established. The petty cash fund is debited or credited again. This is an example of the petty cash receipt. Okay, and for the delivery expense, make sure everything's done that way. And my example, petty cash payment report here, receipt, all the office maintenance example. November 2, washing window, 17 washing window, computer repairs, 26 total here. Okay, and then we get transportations here, and then delivery expense here, total receipt here, total receipt 7130. We have to fund total 75, cash remaining 220, and we have to replenish 72.50, cash over $1.50. Okay, this is a typical operating cash flow financial statement. Okay, important tips: step to reimburse the petty cash. Add all receipt, the one that I just mentioned here in the previous slide. Add up all the remaining cash in petty cash fund. Calculate overshot of the petty cash, and then cash required to furnish the original amount, and record the journal entries. Okay. All right. Let me go back here to make sure you understand here. Here's all the receipt, and this right, and the total here, the remaining here, the equals is here, the cost overshot here. Okay. So step by step here, showing up here in your slide. Opening cash flow, make sure cash required to replenish petty cash is equal to fund size minus cash remaining. Easy to calculate cash overshot is that cash overshot total petty cash receipt minus cash required to replenish petty cash. Okay, in this particular example, we have about $2 short. Okay. Now, another one example here, how to book it. It's going to give you a detail. Office maintenance 46.50, merchandise 11.05, delivery expense, office supplies, cash overshot $1.50, cash is $72.80. This is how you book it in terms of post journal entries. Okay, remember guys, you have to do a post journal entry on this, posting the journal entry of all your petty cash expense. Okay. When you increase it petty cash, addition to decrease or increase petty cash fund often made to fund in the reimbursement, petty cash fund from 25 to 75 to 100. This is an example. Petty cash is 25, office maintenance 46, merchandise 15, delivery expense 5, office supplies 475, cash overshot $1.50. The cash is gonna be 97.80. So because you increase it from 75 to 25, you add additional $25 here. Okay. You increase it by $25 here. Okay. All right. This is your checkpoint. Okay. And let's step number 5. Objective number 5: banking activities control. From the business established, we make sure. Okay. Banks safeguard cash, provide detailed and independent control, record cash transaction, and are source of cash financing. The key bank service, including bank account, bank deposit, and checks, each of these services contribute to the control of safeguarding the cash. So every day, there is always a reconciliation officer to make sure to control, to check all, to reconcile all the banking activities and bank account. The bank account here, the next slide. All person authorized to use a bank account must sign a signature card. So there's only when I was in Royal Alliance, there's always a authorized signature. Okay, authorized signatures. Let's say a manager can assign up to $5,000, director up to $10,000. Anything that's above 10,000 has required to do vice president. Okay. Those are signature cards. It's called signing authority, they call it. Many businesses are required to have dual signature on check and strengthen control over cash payment. Many companies have more than one bank account for various reasons. Okay. Bank deposit. Bank deposit supported by deposit slip. Companies use deposit slip, list items such as currency, coins, check, deposit along with other their dollar amount. When deposit bought to bank, companies provide recovery deposit slip and deposit as a proof of their deposit. This is an example of the bank deposits of the statement 240 here. See, the deposit here, and then we have also here 203 in each of the checks that's being issued. 203 here, 203 here, match it here, 203. Okay. Bank check. Bank check is a document signed which is the by the depositor instructing to the bank to a specified amount of money to a designation recipient. Check involve three parties: drawer, which is the drawer, which is referred to the payer, and then payee, which is the recipient, and then the bank, which is the where the check is drawn. Okay, both check and deposit are imprinted with identification and in magnetic form. Okay, so we go to the next one. This is a typical bank check example here. Okay, exactly, put it down. Make sure our record keeping is done. Okay. Meanwhile, for EFT, electronic fund transfer, is the use of electronic communication to transfer cash from one party to another. Companies are increasingly using EFT because of its convenience and low cost. We see the items such as payroll, rent, utilities, insurance, and interest payment are being handled by EFT. This is standard way, okay? The bank statement lists all cash payment, withdrawal by EFT with checks and other receipts. Most of the people like me, myself, I do my electronic banking for all my bills. It's the easiest way. The company is doing the same thing, most of the company, okay? Credit card transactions. Okay, many companies allow customers to use credit cards such as Visa, MasterCard, American Express. This is a standard way of giving things. They pay a fee for services provided by credit card companies. The fee cover cost include credit card company and credit card customer, cost of collection, profit margin. Therefore, the fees is deducted. The cash is received by retail less than 100% of sales revenue and transaction. The fee charged by credit card company can be calculated as a percentage of sales. It may be depending on the volume of sales sold. So the credit card transaction that is being used for any retail, there's always a charge. Okay. So many of the stores, if you see in some of the stores in GTA, especially in Chinatown, they don't accept credit card. Why? Because they do not want to pay the fee. Credit card transaction. Example of credit card transaction here. Instant 100. This is an example. Take $100 credit card sales with a 4% fee. So how are you going to book it? Cash will be $96. Debit. Credit card expense $4. Sales will be book it credit $100. Meanwhile, the cost of sales. Example is cost of goods is $40. Debit. But charge is $40. So this is how you could record the bookkeeping in terms of the sales. Okay, you have to know how to post them. In debit transaction, is that the use of debit card is common and popular with customer. Payment purchase is transferred to the customer bank account and vendor immediately to the point of sales. And usually you require pins. Okay, how do you book the debit card? This is an example here. Purchase $100 service on October using paid debit card, bank charge 40 cents. So there's always a fee for everything that you use electronic. Cash is $99.60 debit. Debit card expense 40 cents. Service revenue $100. So that's how you book it. Okay. The debit card expense is always cheaper as compared to credit card because the fee is much cheaper. That's why if you see some of the restaurant in Toronto, they prefer to use debit card. If people don't bring cash, most of the transactions these days are not using cash, they use debit card. Okay. Alright. Contactless payment. This is the most standard way now these days across the board. If you go to China, they use WePay. And then here we use Apple Pay, Google Pay, Samsung Pay is in Korea, Fitbit Pay. And in part of the country like Indonesia, they use GoPay and other different kind of pay. Here in Canada, we have a number of major companies like RBC, Scotia, and TD. They use Interact Flash. Okay, it's a built-in radio frequency chips. Okay, and credit card company mostly like Visa, MasterCard, American Express, and there's also Diners. There's also other brand of credit cards. It has everything. It has an integrated circuit chip and antenna. This is the way of the future now. Contactless payment is the way of the future. What are the advantages? It's because of the efficiency. Okay, in 2020, 89% Canadian carried a credit card, and 34% with credit debit card. This is the trend now. Everything now go cashless. Everything uses contactless payment. So you just tap it, use it, interact. That's the way to do things. Security is another advantage. It's a growing concern with the increase of payment, increase in fraud. So it reduces the level of fraud. But there's also issue like skimming, counterfeiting, transaction replay that are related to the contactless payment. So we are seeing also this in terms of skimming, counterfeiting. So you have to make sure you be careful every time you make a payment. Okay. Make sure nobody have your numbers. Make sure there's a code there. Nobody have the 3-digit number code of your credit card. Bank statement, checkpoint. This is your checkpoint in terms of credit card and debit card. Make sure the benefits are available to retailers. Bank statement. Bank statement are a different bank use a different format. There's always the beginning of the balance, and then check and other debits decreasing the amount during the month, deposit and other credit increasing the account during the month and the end of the day. Okay, what we're gonna do, we're gonna look at the example of the bank statement. This is a typical example of bank statement. Check and deposit. This is check and debit, deposit and credit, daily bank account. See, step by step it summarizes the check account. B listed paid checks. Okay. C listed the deposit and credits. And D show the daily balance. Okay, these are the differences. This is your important tips. I will skip that slide. We'll go to the bank reconciliation. This is one of the most important objectives. Number 6 is a form of internal control over cash to explain the difference between the balance of checking and according to deposit records and the balance report on the bank account. That's very important. I mentioned to you earlier in the previous slide. There's always somebody doing a reconciliation with the cash to make sure everything matching. If there's dancing, that has to be investigated. The purpose of this is to reconcile two balance and to explain or account the difference between the two balance. Okay. Bank balance adjustment. You can add unrecorded deposits. Okay. Deposit made and recorded by depositor but yet not captured by the bank statement, or deduct the outstanding check which is written for outstanding payables and expense resulting in decrease in company cash account. Number 3, adjust for errors. Both bank and can make errors. Okay, this is your important tips. We only do adjust that have been recorded and correctly for the accounting records. Okay, this include the outstanding check that have been written and supplies that have not yet been withdrawn out of the bank account. So example, you write a check but it's already past due, that the recipient forget has not banked it. Okay. Book balance adjustments. You can also doing the add in terms of interest earned, unrecorded cash receipt for collection and transfers. Because why? Because bank sometimes as a collection agent for their depositor. Okay, when the bank collect on time, it adds to the deposit account less the service fee. If the amount current interest, the bank statement include the credit at the amounts earned during the past month. Also deduct the NSF check and service. NSF is non-sufficient fund. And a company deposit customer check that is uncollectible. That is the reason why. Okay, let's move on to the next one. Adjust book balance can be plus minus because of error. The error can happen, so there has to be adjustment as well. So this is your important thing in terms of showing up a GL as collection and error. Okay, we're gonna do a comparison of bank and book balance adjustment. Bank balance adjustment, which is add deposit in transit, subtract outstanding checks here, add and subtract correction of the bank error. In terms of this is bank balance adjustment. In terms of book balance adjustments, oops, let me just go back here. By accidentally I punched the previous slide. Add the interest earned and unrecorded cash receipt and subtract bank fees and SF checks. Okay, add and subtract the correction of book errors. Okay, so do the difference between the comparison of bank and book balance adjustment. Okay, important tips. There is a bank reconciliation terminology between bank account versus cash account. Bank account refers to the actual account cash held by the local bank. This is referred to the checking account or payroll account. The cash account is the company internal account record that summarizes all internal reporting accounting transaction in the company general ledger. Okay, that's the difference. Now illustrate the next chapter. The step compiling a bank reconciliation. There's 9 steps here. Obtain bank statement, identify the bank statement and cash account, and then add the unrecorded deposit or any bank errors. Okay, And then number 3, subtract all the subscription check that have not been processed. Each has its step, exhibit, and each of the exhibit in the books. And then number 5, identify the company balance of the cash account and enter it into the right hand side of the bank reconciliations. Number 6, add any unrecorded cash receipt. And then number 7, subtract unrecorded bank fees and banks such as monthly service charges. Number 8, calculate the adjusted book balance. Number 9, favorite the adjusted book balance. So there's a 9 step. So it's very, very detail oriented, all the steps. So you have to follow that step when you do bank reconciliations. This is your important tip in bank reconciliations. Okay, I'm gonna go important tips between cancel check and versus outstanding check. This is what the difference is. Cancel check can be confusing. This term refers to check that have been written by company that have been processed to bear their account in the bank. Example: a check is written by supplier to inventory and deposited to the bank account, residing and transfer money from the bank to the bank account. Check that you are in the bank account, such as withdrawal of funds, are all cancel check as the payment have processed to the account. Okay, this is the term. Outstanding check is that it has been written, have not yet been processed to the company bank account. Okay, this is the big difference. Okay, the term. Look at this detail here. All right, this is an example of the DM, NSF, DM, all this. The term here, the term are available here. CM means credit memo, DM is debit memo, NSF means non-sufficient fund, EC is error, IN is investment earned, OD is overdraft. Okay. All right. In terms of bank reconciliation, we're gonna see here Exhibit 7.7. We have it appeared that October 3 there's a deposit 145 here, 145. And then in exhibit here, number 3, except from disbursement, check number 124, 126 has been written but are not in the bank account. Okay, an example of all these exhibits. And then the reconciliation, you reconcile number 5 here, the total, and make sure the balance must be equal there. Okay. All right, let's look to the bank reconciliation. When the reconciliation happens, the company must send a copy to the accounting department and record the needed journal. For instance, the entry must be recorded and the adjustment made per books, and another copy go to the cashier office, especially important for the bank to make error and needs the corrections. Alright, recording adjusted entry, identify the bank reconciliation assets. Okay, they are also processed in terms of the final stage, meaning to investigate the journal entries needed to be recorded to ensure the cash account is correct at the end of the accounting period. Alright, recording adjustment example here given to you. Cash is posting is 485, collection expense $15, note receivable is 500. Okay, collection note. Number 2, interest of earned, cash is 8.42, interest income is 8.42. Okay, in terms of the adjustment entry. All right, and the SF checks is another example here. Posting is 31st, account to Frank Heflin is $30 here, and then cash is $30 here. Okay, and then in terms of adjusting entry, check printing, office supplies $23 here, debit, and cash credit $23. Okay, those are the important tips doing the entries. Control related to bank reconciliation is a very key part. Why? It should be reviewed on a monthly basis by an independent party to make sure there's no people tying up, cover up for theft or cash. Okay, this is your checkpoint. Okay, and then this is your quick ratio. That's objective number 7. To do a quick ratio is asset ratio, which is quick asset divided by current liability. It's basically is a ratio that can convert it into cash, include cash short-term investment receivable. Okay, this is called, why is different? Because it is less liquid side, because it is less liquid, because inventory and prepaids are not liquid. Okay, remember that. This is a good quick ratio comparisons between company in 2020 from 2018 to 2020. Okay, the quick ratio and current ratio, the two examples given to you. Okay, critical thinking. This is an example of quick ratio on how to do a favorable or not favorable. We'll discuss in detail in much of the summary of the exchange. Okay, so we basically conclude all the summary and define and explain. This concludes this chapter of internal control. The rest are basically a summary of what we have discussed. Thank you. See you in the next chapter. Bye.